What's going on, everybody? Liam O'Reilly, Vermont Economic Realtor. Hope you're doing well. Wanted to talk today about the overall state of the economy and where things are going in the housing market. If the Federal Reserve can slow down the housing market enough, slow down the economy enough to have a dramatic effect on the housing market. We're going to look at a few different graphs here, walk through everything, and talk about what that means for the future of the housing market and go over some potential scenarios. So let's get right into it here. Starting off at the Fred website, the St. Louis Fed, looking at M2 money supply. So I wanted to just briefly talk about some of these indicators of what's happening with the economy, with inflation, with these tighter rates, what's happening to consumers, and at the end of the day, home buyers, which are the driver of the housing market, right? You can have as many sellers as you want, but if nobody's there to buy the home, then it's not going to sell. So if we look at this, the M2 money supply, we're seeing it drastically decrease. And this isn't anything new. It's been trending down for a while now. So people, this is the overall money that people have. And it's trending down. M2 is trending down. So people generally have a less money. Something that we've talked about extensively on this channel is the consumer loans. If we look here, consumer loans, this is credit cards, revolving loans. You can see it's increasing to record highs and increasing at a record rate, right? If we look at the rate at which consumer loans are increasing, they're increasing faster than they have in the past. Basically faster than we've seen over the past decade. So, consumer loans are going up, M2 is going down, and the personal savings rate of consumers is very low. We're seeing it at or near the 2005 levels if we look at this chart. So, in my opinion, this data doesn't seem very good, right? People have less money, people are taking out more loans, they're saving less, but yet we have this, Redfin article. I'm not going to go too deep into Redfin because I just made a video about the previous housing market update, but the headline here: early stage home buying demand hits highest level since May. And here we go. I'm just going to read this subtitle here. Redfin's Home Buyer Demand Index, which measures requests for tours and other buying services from our agents, Redfin's agents, jumped as prices fell for the sixth straight week and mortgage rates declined for the third week in a row. Excuse me, but lack of new listings is holding back sales. So, we've covered this in many videos. There's not a whole lot of inventory coming to the market, and home buyer demand is ticking up even despite higher interest rates. And yes, more home prices are down year over year, but they're not down by much. 1.7% nationally, and in some markets, in a lot of markets, they're up. And they could be up pretty significantly depending on the market that you're in. So, with all this bad economic news, the real question is, the economy is in a good enough place where the home buyer demand is still very strong, right? There's layoffs at tech companies that you've seen. I'm sure you've seen it in the news. People have less money than before. People are saving less than before, and people are taking out more consumer loans. Yet home buyer demand still well outpaces supply. So will we will we get to a point where the Federal Reserve hikes rates too far, where things break, where the unemployment rate rises too high, so that the housing market can actually cool down and we see dramatic price drops like I know a lot of YouTubers are talking about, and I know some markets are experiencing, but on a broader national level, or especially here in Vermont, in my market, what will we get to that point? So let's look a little bit deeper into these Redfin charts just to give us a background of what I'm talking about here. So median sales price. This is what I mentioned. Look at the rate at which, yes, it's down 1.8% year over year to 360,500 across the country. But look at the rate at which the median sales price is increasing. It's still down year over year, but it's shooting up significantly. And I think, you know, at the end of the day, yes, rates are higher, and yes, it's more expensive to own a home. But at the end of the day, people purchasing a primary residence to live in, and that's really what we're talking about on this channel. For most people, it's not an investment. And I've made this argument before, but I'm gonna attack it from a little bit of a different angle, in the sense that people's primary goal when purchasing a primary residence isn't to make money. Most people aren't buying primary residences to flip it. They're buying it to live in the home for an extended period of time and ideally not lose money, whether that be to rent or 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 whatever. If they can break even on their home, that they're fine with that. But at the end of the day, they're not. The driving factor behind them purchasing a home for most people isn't to get rich. I mean, everybody thinks, in 30 years when the mortgage is paid off, that's going to be great to have this asset, to have all this equity in a home. Essentially, it's like you're putting money towards your equity each month instead of putting money towards somebody else's rent or rent that's paying down somebody else's mortgage. So that is a factor. But most people buy a home for other reasons, to have security over the place that they're living, to have control over their property, to have the security that nobody's going to come and kick you out if you pay your bills on time, right? And that monthly payment, that secure monthly payment, yeah, it might be a little bit higher than what people would like, but at least they're not throwing away money to rent. I mean, I hear that all the time from the buyers that I work with. And it for a lot of people, it's a better option. At least they have control. At least they know that rent's not going up. At least they know that they're not going to get kicked out of their house. So although rates are high, it still well outpaces supply here. And that's really holding up the purchase price. Now, if we look at the chart of the home buyer index that Redfin has here, Redfin Home Buyer Demand Index down 24% year over year. You see the red line is 2022, but we're still well above 2020 levels, which is a more stable market, right? There's more people in the market looking to purchase homes than there were in 2020 in that normal market. And this is despite people taking out more debts. This is despite being able to save less. And this is despite, having less money in the system. So, what all those things really, what that tells me is that people are motivated. People are very motivated to purchase a home, and it's for reasons outside of a good investment. I think it's, for security, at least for a lot of the buyers that I work with, for security, for stability, to have control, maybe a little bit more space. A lot of times you can buy a home that is a bit more spacious. So, and they're willing to pay a higher price for it, even if they're stretched a little thin. At least a lot of the people that I work with. So, as we move into the future here, what are the economic drivers to watch out for if this is going to change, if home buyer demand is going to get back down to 2020 levels or below 2020 levels, which could potentially cause the housing market to really flip, right? That's what a lot of people are predicting, is that the housing market is really going to flip. And I think, obviously if we see a massive banking crisis and we see banks fail and that spirals into the rest of the economy, that could impact things. I think a big risk is the unemployment rate. In Jerome Powell's latest rate hike announcement, he was asked about the unemployment rate and how he knew it wasn't going to spiral out of control. And he basically said, look, I don't. So I think if unemployment rate shoots up to around 10%, that could really hurt buyer demand and bring it down back into normal levels. The thing that I wanted to, a thought I wanted to share with you folks as well is, if the unemployment rate shoots up and we see people can't pay their mortgage anymore, do you think, we just went through COVID where people were forced to lock down, people couldn't pay their mortgage, and we had this forbearance period where people didn't have to pay their mortgage. The government said, don't worry, stay home, don't pay your mortgage, everything's going to be okay. My question, and I don't know the answer, to you folks, and something to think about, is if we experience some extreme economic hardship in general, do you think the federal government is going to allow foreclosures to happen like they have in the past? Or are we going to enter into, some special grace period like we did during the pandemic where people don't have to be foreclosed on? Because a lot of the foreclosures that would happen would be different than 2008. I mean, yes, people lost their home. A lot of people lost their home in 2008, but a lot of people were well overextended on the type of financing that they had. And then when all of a sudden the loan switched and the products came due, they they lost the property, and it's a property that they probably shouldn't have had to begin with. Where now a lot of people are well qualified for their loan, and so when if they lose their job, they don't have as much savings as they used to. They're already maxed out on their credit cards. How are they going to pay their mortgage? Is the federal government going to add some sort of forbearance? And I kind of think they might, to keep people in their homes, because it's a real issue for the federal government to have people getting kicked out of their homes and tossed into an environment that has such a short housing supply, where rent has gone up significantly and there's not that many places for people to go. And so if foreclosures are happening all over the place, and people are without their homes, and there's not a lot of homes for them to go into, because remember, we haven't been building like we were over this past decade. I think there's a good probability that there's some sort of forbearance. And then really quick, I know we're getting to the end of the video here, but if that happens, how does that affect the secondary market, the mortgage-backed securities? Are investors going to feel confident in purchasing mortgage-backed securities when the government is offering these forbearance periods? And especially if they do, how many of those are they going to offer into the future? I think there's repercussions to forbearance. The forbearance period that happened in the pandemic, it kind of sets a precedent moving into the future. And it's just, it's just food for thought. Are massive foreclosures coming? Is a massive supply coming to the market? What would the economy look like if that happens? If home buyer demand drops? These are all questions that you should be asking, especially if you're leaning towards the market completely crashing, as I know a lot of YouTubers are preaching. I personally don't think it's going to fall out, and I think a big reason for that is that the federal government can step in like they have in the past. So anyway, Liam O'Reilly, Vermont Economic Realtor. If you're looking to buy or sell a home here in Vermont, all my contact information is in the description. Let me know what you think. Was kind of exploring ideas in this video. Would love to know your thoughts. Leave a comment, and I'll see you guys in the next one.